And yields make a big move lower midweek. Today closing down around 435. That's down about 10 basis points on the session. The lowest trade we've seen since going back to May 9th, the lowest close we've seen since going back to May 7th. Now, a lot happened today. We had the ADP data as well as the ISM non-manufacturing index. Both came in weaker than expected, prompting the short end to start repricing in one of those 2 rate cuts later this year back into September. So as we saw weaker data come in, we see some of those rate cuts get nudged further, or closer into September, prompting lower yields across the board. Now, we didn't see the curves move all that much. The 2-10 was relatively unchanged, maybe a basis point or two off yesterday's close, but ultimately it was a parallel shift across the curve. We saw yields drop to their lowest since going back to May 7th. Again, seeing yields down about 10 basis points, closing out near 435. Now, what does this mean for volatility? Well, check out that CVol index over at cmegroup.com. And while we've seen volatility in decline recently over the last, say, 4 or 5 sessions, it's been roughly unchanged. That was the case today, despite the fact that yields were lower. Lastly, let's talk about what we have tomorrow. Tomorrow is Thursday, which means we get our in-the-moment look at the job market via the claims number. Before that, we'll get the challenger job cuts. We get challenger job cuts, then jobless claims. We also get an ECB meeting thrown in there, and then we'll kind of hear from more Fed speakers who've been out and about all week. But really, what this week is all about, what it's been all about, is the jobs data on Friday. The market will be looking ahead, trying to price in what could or couldn't happen. Obviously, the ADP and indication of non-farm payroll was weaker, so the market leaning towards a weaker possible non-farm payroll number.